All right, I've been wanting to do a video on mean reversion as an important concept that you can use and apply to different domains in the investing world. It's really helpful concept. So first of all, just a minute on what it is. Basically, mean reversion is the tendency of things in nature, in markets, to sort of revert to a mean, to revert to a level that is sort of average. And in other words, if something happens that is way above average or way below average, over time there's going to be sort of a gravitational pull to bring it back into a normal range. So this is sort of just a generalized conceptual framework that you can apply specifically in investing lots of different ways. You see it show up in profitability metrics. You see it show up in market share. So if a company in an industry starts to gather a lot of market share, well, there's going to be a response from other competitors. They'll cut pricing or improve the product or their quality of their product or whatever. And then that market share will be won back by the competitors often. So this is an example of mean reversion of market share. You also see it in commodities. So just think of like the price of gold. As the price of gold goes up, that sort of applies pressure on mining companies to increase production, or for even companies to open new mines, which will happen with a lag. But this also will later put downward pressure on a gold price as production increases. You can see this in an industry like the chemical industry. If they have an extended period of strong pricing, there's going to be gravitational pressure downward on that pricing because the response to high pricing is other players will increase capacity, which means more product for the same amount of demand, and that means there'll be this mean reversion of pricing. So these are all phenomena that happen over and over again in the stock market. And actually, you can even apply this directly to stock prices themselves. If you think of them as sort of a product of, say, the investment banking sector, of equity paper, or of entrepreneurs or private equity firms that want to take their companies out into the public market. So there are certain times where pricing is high, meaning there's a lot of demand for new IPO paper. And believe it or not, they're just going to make paper. They're going to make new companies go public sooner than they otherwise would. We saw this in the 1990s tech boom. A lot of companies came public when they probably shouldn't, but there was a lot of demand for paper. And then, of course, mean reversion happened and the demand rolled over, and all of a sudden nobody wanted this sort of immature company paper. Well, this happens in cycles in IPO markets and in public stock markets. So you want to think about mean reversion as a general concept that can drive periods of outperformance and then periods of underperformance. So if a company is showing higher than expected profitability, for example, and you would measure this by maybe operating margins, something like this, you would look at that and you would think, okay, if this is a situation where there might be mean reversion, I probably want to sell this stock or certainly not be buying it now because they're over-earning. They're earning at profit margin levels higher than normal, and they'll probably mean revert back. Likewise, the opposite can be true. You can see a company that has lower than normal profitability, and if you can argue a good thesis that that profitability will mean revert back up to a higher level, then this is a case maybe for buying that stock, even though it's under-earning at this time. So these are kinds of ways that you can apply mean reversion to your investing and make good money, actually. You just have to be a little bit more patient than everyone else and see this mean reversion process happening and just sort of understand that when things are better than ever, they're going to go back to being normal. When things are worse, they're going to revert back to being normal again. So these are opportunities to both exit or enter stocks. So again, think about this theme, think about ways to apply it, and as always, I hope these videos are helpful, and thank you for watching.